Hi everyone, welcome to Trader Chats, unique perspectives from seasoned traders. I'm your host, Imran Lakha, founder of Options Insight and 20-year professional options trader. As you might know, I became a trading mentor about 3 years ago, but I thought these conversations would be a great way for my students to gain valuable perspectives from some of the professional traders that I know and respect. I hope you enjoy the episode. Welcome back to Trader Chats, everyone. Today, I'm joined by the legend that is Darius Dale, founder of 42 Macro. Darius,
are we talking finance? Or are we talking sci-fi Sunday? Which legend?
Legend, past legend and future legend. Darius Dale, welcome. How are you?
Imran, it's a pleasure, man. Thank you so much. I appreciate you having me on.
No, it's great. It's great. I'm really glad you could make it. And why don't you, before we start, why don't you just tell us a bit about your background in markets and where you learned your skills?
Yeah, no. So the background in markets comes from, I guess I spent the first 12 years of my career at Hedgeye. I'm sure most of you guys watching are familiar with Hedgeye for many different reasons. So my last role there was the sector head of macro. I was there in that role for about 4 or 5 years. Most people know me. I sort of cut my teeth and earned my name in finance and global Wall Street for designing what they call the quads. That's their 4-quadrant regime segmentation process that they use to guide their asset allocation decision making. So that's my baby. That's sort of what I built while I was there and kind of really maintained and ultimately used it to catapult myself into some notoriety. Knock on wood. We'll see if it continues. But in terms of it was a 2-part question. You said, where did I learn my skills? So as you can probably see, I went to Yale, but I certainly didn't study finance at Yale. I took my fair share of quant classes, but it was not something that interested me, quite frankly. I was very much on the path to doing the law and the government sort of thing a lot of folks do at that institution. And it kind of came clear to me that after a few years that, look, man, I don't think I want to keep going to school. Like by the time I was a junior, I was like, I think I'm over school. I don't know if I want to start applying to law school. So I was like, I got to make a career pivot so I can go, work somewhere, without having to go to school after college. And obviously, finance was the thing, but this is 08. And so, like I'm looking for internships in finance and I'm like, this isn't working, like I'm hitting up all these former Yale studs on Wall Street and everything, because that's kind of what you do. You go to a place like Yale, Harvard, and you send an email to an alumni, play your sport, and they give you a job. That's typically what happened. That stopped in 2008, and it really hasn't picked back up since. Right. And so, kind of the reason I wound up at Hedgeye, Keith, the CEO of Hedgeye, Keith McCullough, he puts out this full page ad in the heart of the financial crisis. This must be like right after Lehman went bankrupt. Hey, we're hiring, and so, I kind of replied to the ad and kind of the rest is history.
Like we're the only people who are hiring right in the middle.
We're the only people in this industry hiring right now.
Right. Okay.
Fortunate enough to take advantage of that.
Nice. All right. And your specialism is what we'll call quant-driven macro, right? Is that fair to say?
Yeah.
And I guess the first question I would ask you then is, why quant-driven macro as opposed to the old school way of that's worked well for the likes of Paul Tudor Jones and Soros, like those old school guys who run macro positions for long periods of time. They just they have a position and then they ride it to the death. Like, what is it about your style, your quant-driven that pushes you in that direction, and what makes you think that's the right way to do it as opposed to the other stuff?
So I'll start by saying there's a million ways to skin the cat. I don't think there's a right or wrong way to invest. I think the only wrong way to invest is to not learn from your mistakes, is to keep making the same mistakes over. And that's pretty much, that's a truism for life as well, right? There's no one right way to live life, but there's certainly a wrong way, and it's to keep making the same mistakes over and over again. With respect to quant-driven macro and why I was led down that path rather than your traditional discretionary macro, because I dabbled in discretionary macro earlier in my career, trying to use things like weather to predict ag prices and things like that. And quite frankly, until I really stumbled upon Ray Dalio's work with the all-weather system at Bridgewater, I didn't really have a good mental framework for thinking about, for just diagramming and disclosing and more importantly, segmenting risk and understanding how risk behaves. And quite frankly, with respect to your legacy discretionary macro, and there's still some funds that do a really good job at that. But for the most part, that's been a dying industry in terms of the returns, in terms of the assets under management. And the reason for that, in my opinion, and again, this is my humble opinion, I think this market structure has changed such that it's no longer favorable to take those kinds of bets on a consistent basis, to make those kinds of bets. The level of sophistication of market participants that are not specifically macro driven is much higher than it used to be. Like you can hop on FinTwit and really get the rundown on all the main macro narratives and drivers at any given time. I'm not saying you're going to be forecast them going forward, but you can certainly get up to speed really easily, with free resources. And those investors back in the day, in the 80s and the 90s and the 70s, and even up to the early 2000s, they had a real stranglehold on, that information. They could talk, they could call the Bank of England, they could call, not the People's Bank of China, but they could call. They had people, working in the Fed, the New York Fed and things of that nature. And there was just a lot more information arbitrage to take advantage of back then, and there just isn't anymore. And
so the dislocation in the macro asset would be so much bigger, and you could get on that trade. Whereas now you blink and you miss it because the machines
they
are all
hardly show up. They hardly show up, and the reason they hardly show up is because macro markets have become significantly more efficient with the advent of new players into the system, primarily through the advent of ETF, the ETF machine. It's a machine. I mean, you go back to 20 years ago, right around when you first started in the industry, you couldn't just wake up and get exposure to triple C credit. That was like a big deal if you could find a fund that could get you into that kind of asset class. And obviously there's significantly more esoteric asset classes within fixed income and within structured products, things like that. You can replicate a lot of these same returns using ETFs now and using different funds now. And so the reality is there's just a lot more people involved, and there's a lot more smart people involved. And I think that's why I believe quant macro has been, I would say it's the future, but I would argue it's been the future since, kind of the early days of my career.
Makes sense. And so your process, the way I would kind of summarize it, because I'm a big fan, I'm also a subscriber to 42 Macro.
Thank you, sir.
So I see it as you say it's a combination of a macro regime nowcasting process and a market regime price signaling process. And when you combine those two, that's what makes it so powerful, basically, right? So could you talk a little bit to that and how that works and why you think that's the case?
Yeah, so I think you of all the interviews I've done thus far, you've summarized that best. And what you mean by that is we have sort of two separate processes running simultaneously at all times. And the intersection of those processes is what creates our asset allocation recommendations, our portfolio construction recommendations. And so on one side of the ledger, you have what we call our top-down market regime nowcasting process. That's done through the lens of what we call our volatility adjusted momentum signaling process, whereby we're getting information from the 42 most liquid, heavily trafficked in markets across the world as leading indicators for one, not only future market activity, market dispersion within and across active markets, but also leading indicators for what's likely to happen in the economy. So that, if you can sort of think about this in simplistic terms, that process is the weather. What is the weather? But obviously, if you're going on a road trip, then I would argue investing is very much akin to going on a road trip. You obviously need a map. You need a roadmap. You're not just going to get in your car and start driving and hope to wind up where you want to go in any reasonable amount of time without having a map. So what we call our bottom-up macro regime forecasting process, that's what we're doing. We're trying to use economic information, high frequency and low frequency economic data, to project, to measure and map the likely path of growth and inflation in the economy. Because of what we know, what we found through careful backtesting, I spent most of my career constructing and comprising these types of models and backtests. What we know is that policymakers react to certain functions in the economy. Big deviations in growth to the upside or downside, big deviations in inflation to the upside or the downside, big deviations in financial markets, to the upside or the downside. And so what we're trying to do is use our ability to forecast what's happening in the economy to ultimately anticipate how the weather might change. But, at the end of the day, what we're trying to do is get into a car and not just say, hey, I have a map to get me to XYZ. Well, if it's snowing and it's a blizzard outside, you might want to put on snow tires. You might want to actually, leave tomorrow. Like that's what this process is doing. The top-down market regime process is doing, and the bottom-up macro regime process is saying, okay, what direction do I want to drive the car? And that to me,
I like the analogy. Really like the analogy of the weather and then the map, right? And you need a combination of both safely get you there, basically.
To safely get you there, exactly. You can get there with one or the other. I mean, maybe not the weather. You can get to where you're going without both, but it's more dangerous. You're gonna, as an investor, you're gonna incur more volatility in your portfolio. Interesting.
And the idea, I guess, so the back testing that you do. Well, actually, there's two things I wanted to ask. So I notice a lot of the time you're analyzing the rate of change data on growth and inflation to figure out what grid you're in. Okay.
Yeah, that's it.
But often I see you trying to almost second guess which grid we're going into. You're like, right now it says we're in grid inflation, but I reckon we're going to reflation. And that's almost like you bringing in your own discretionary style, because you're so used to seeing this data jump around and move around that you're analyzing the quant numbers. So this is what it is actually telling me. But based on my experience and my kind of feel for this, I see us heading here, basically. Is that fair to say?
That is extremely fair to say. I say this all the time. It's not enough anymore to be just quant or just fundamental.
Yeah.
Like fundamental would just be me, not licking my finger, but just based on my experience and my feel saying, I think XYZ is going to happen. Therefore, I'm going to position for XYZ. Purely quantitative is saying the model says XYZ is going to happen. I'm only going to do XYZ because the model said so.
And until the models change, I'm not allowed to change.
Exactly. And what quantamental is the intersection of those two processes, whereby you say, I'm going to empower my decision-making with the quant, because that over time will give me the best opportunity to demonstrate superior and consistent results. However, you need to have a human being in the system, right? Because any model, anyone who's built a model, the first thing you realize is that they're always backward looking in terms of how you train them. You can't train the model with forward looking data, but as an investor, we have to invest, based on our expectations of the future. And so the model can sort of, what models do, at least how we employ models at 42 Macro, is they narrow the range of probable outcomes. There's all these things could happen over the future. And obviously the distribution gets wider as you get away from T0. As you get further out in time, the distribution widens. And what you're trying to use models for is to actually compress that range of outcomes so that you can make informed investment decisions on a consistent basis.
Yeah, the way I'd say it is it keeps you honest. Right, you might have a view that reflation's coming, right? And you've nailed it, by the way, recently. But let's say the data just kept telling you that actually it's not happening, right? Let's just say, and I'm going to ask you a bit later about that because I've got some questions on that. But basically, it keeps you honest, so you don't be stubborn to your view. If the data is telling you something that's different to your view for long enough, you just got to accept it, be a big boy, and move on, right? And I think that helps,
and this is, most people are kind of interacting with me as a person now at the highest frequency they've ever done. But for, many, many years, that was just sort of like, behind the curtain at Hedgeye, only talking to institutional clients for a long period of time. And so, you kind of brought up something that always resonated with me, which is the goal of this whole exercise is to make money. And like when I'm talking to a hedge fund portfolio manager or a mutual fund CIO or the head of a family office, I can't be like, talking about something that's going to come to fruition over some long extended period of time. These people have performance figures they need to hit. Quite frankly, they have career risk associated with not hitting those performance figures. And so I've always taken it upon myself to be very, very, to take that burden of being part of their team or being part of their investment process very seriously, because there are real implications for capital misallocation on the buy side. And that's part of where this process has come from. It's using the data to make sure you keep yourself honest and not too far out in the future with some sort of Pollyannish or ultimately extremely bearish views.
And so back to the back testing side. So I noticed, you back tested all of your assets to those different regimes that you think we might be in.
Yep.
And then do you just sort of say, okay, well, I've back tested it, so in that regime it goes up or it goes down, or do you try to explain why in Goldilocks we tend to get these outperformers, these underperformers? That makes sense from a sort of, it just makes sense from a qualitative point of view, right? The quantitative is telling me it's there, but qualitatively it also lines up with what you should expect in Goldilocks or what you should expect in inflation and stuff like that.
Yeah, so I'm grateful that this is how that Dalio and others have figured out that this is how the markets actually work, because the reality is very few and far between do I observe anything in our back tests that doesn't make fundamental sense, right? Like you talk about Goldilocks. So what does Goldilocks mean? That means growth is trending higher and inflation is trending lower. That typically is, very positive for risk assets. You typically have reasonable returns in fixed income markets. You're going to be hard pressed to find an asset that does not do well in Goldilocks, with the dollar being a noteworthy exception, dollar, yen, Swiss franc, those types of risk off currencies. So that makes fundamental sense. I don't, if I say the word Goldilocks, I think most people understand what that means generally. Now we understand what that means a lot more than generally. We back tested everything that ticks through the lens of those grids: Goldilocks, reflation, inflation, and deflation. Through the quantitative prism of annualized expected returns, percent positive ratios, volatility, covariance, percentile, all those things. You name it. If there's a descriptive statistic, we've applied it through the lens of our grid regime process.
How far back do you go to test that?
We can go back as far as we want, but right now the back tests are currently set up for the trailing 25-year period, because I do not necessarily believe we've exited the policy regime that we've been in. And it's really not the 25-year period. I do believe that most importantly, the Q1 of 1990 or January 98 is probably the most relevant data set to train any sort of back testing asset allocation model on for the current juncture until we've proven we've exited from this regime. And what I mean by that is, we went from asset markets being the primary concern about asset markets for a long period of time was inflation. And with the advent of LTCM, and more importantly, the market response to the Russian default, and the Fed's response to the LTCM bailout, the market fear switched over to deflation. And it really has been deflation since that time period. Now, you could argue, and we can have a great, healthy debate about whether or not we've transitioned back to the primary market fear being inflation. But until we've proven that otherwise, I still think this kind of trailing 25-year, 23-year window is the most appropriate window to train any model on.
And that's very much a fundamental argument you're using there.
It's a fundamental argument, absolutely, yeah.
But then have you done the work to check on shorter time frequencies whether the back test actually tells the same thing? So have you looked at, over the last 25 years, I've looked at the 5-year periods going back. So those five-year periods, and then am I seeing that it's telling me the same information?
Oh, it's spooky. It does this for like multiple decades. I mean, like you look at the chart of the S&P or the 10-year Treasury yield back test, and you look at it for 1960 or 2000 or the 2000s decade, and it looks exactly the same. Wow. It's shocking how much markets trade off the rate of change of growth and inflation, not the level of growth and inflation, because obviously we've trended lower in both for the past several decades. But the reality is markets function on the direction of travel of those statistics. And, again, people with much more money and intelligence than I ever will amass, have proven this. Obviously Bridgewater is the largest and most successful hedge fund of all time, or was at least at one point in time. There's obviously plenty of other hedge funds who employ similar strategies that I'm aware of, certainly, that I've done work with over the years. Interesting.
Okay, that is really fascinating. Okay, so something you do a lot as well is volatility and crowding analysis, right? And the way I see that is you use that as your timing tools, basically, right? So, you look at implied realized spreads in vol. And I've got a question for you. So you often look at that spread and see if you're trading at a premium to realize or a discount to realize, right? To get a feel for whether the market has bought a bit too much protection, is very well hedged, so we might get a squeeze, or the opposite, the market's complacent, vol's getting smashed, actually buy some hedges here, basically, right? That's kind of what you're always talking about when you talk about that. Now, have you thought about the fact that sometimes when the market rallies off a bottom and it rallies quite quickly, it's realizing quite a lot, right, on the way up. And as you're riding up the skew and implied vol's collapsing really quickly, that kind of overshoots, right? And
Yeah.
it's not necessarily that you found loads of sellers of vol that have just crushed the vol and there's complacency there. It's just that the rally was so fast and you've ridden up what was quite a steep skew that I feel like maybe that signal's telling you that the market's complacent when it isn't necessarily, right? Have you thought?
Yeah, no, agreed. And this is why we look at the volatility, the risk premium analysis that we do in quadrants as well. And so if you think about the upper right quadrant, that's where on the x-axis we have the standard deviation of realized volatility. And so, on the left side of that chart, you have a negative standard deviation of realized volatility, which means realized vol is low. If you're coming off of a market event, particularly one that was meaningful enough to catalyze a V bottom, then you're probably going to be on the right side of the chart. You've had high realized volatility, and that's more indicative of a high realized volatility regime. I'm not telling you, I'm just explaining this to the viewer. High realized volatility regime with an implied volatility discount is a market saying, okay, the coast is clear, the worst is behind us, and the market. And don't get me wrong, like I think let's take a step back from this type of analysis and actually just talk. We spend too much time as investors trying to fade consensus, and not nearly enough time as investors understanding why the consensus exists. Like when you see something going to the bottom right quadrant of that chart, which is again in high realized volatility, implied volatility discount, it's usually because we just had a correction and the correction is probably over. Now, instead of saying no, go fade that now, you should say, okay, why does the market think the correction is over? Is this fundamental? And if it's fundamental, what's the duration with which this recovery can take place?
So that fading kind of bias that people have, people just like to they feel like they're clever, right? They're cleverer than everyone else. Everyone else is wrong. Clearly, I should fade that, and then I'll be a hero when I'm right, basically.
Totally. So it's hubris. Yeah. And look, there's nothing wrong with it in isolation. It's just there's a problem with it in you have to do it in moderation. The second you start thinking you can just fade every market move and you're smarter than all the other brilliant people investing tons of capital in global financial markets, that's when you're going to start to have problems, in my opinion.
Sure.
So keep it, for those of you listening out there, obviously there's plenty of strategies that are designed to take advantage of fading and swing trading, all this stuff, but don't assume that you sitting at home with your keyboard, or even if you have a Bloomberg, that you're just going to figure out global financial markets, because you're not. Just,
I've been trying for 20 years and I still haven't figured it out. So don't worry.
And you won't, and neither will I.
No.
All we're trying to do is help ourselves, our own families, but also help the families of other people limit the amount of mistakes they make, because we're all going to continuously make mistakes until we stop doing this.
Totally right. Right.
I take that back. This is the hardest thing to do in the world that doesn't involve the loss of human life, which is investing.
Yeah, I mean, I tell all my guys, all my subscribers, my students, whoever it is, I say, I've been doing this for 20 years and the market schools me constantly. I'm always getting schooled by the market, right? It's just the way it is. And you have to accept that that's the nature of trading. That's the nature of doing this, right?
And keep yourself one of these. How many notes I take of stuff that I got wrong? It's not because I'm ever going to go back and read it. I don't have time to go back and read it. It's the process of writing it down that causes me to remember this. Okay, what was my thought process when I put this trade on? What was my thought process when I, had, like you mentioned, I had a fundamental view that we now cast ourselves in inflation. What was my thought process back then? If we don't get that, I got to go remember, okay, what led me down that path so I can avoid making that same mistake again. And so I think that's one thing that the pros do really well. And I don't know that the non-pros do really well, but for all you non-pros out there that want to have the same results as the pros, you definitely want to start taking good notes.
And another signal, vol, seeing as I'm a vol guy, I thought I'd quiz you a bit on the vol stuff you do, right? Yeah, the VIX, the VVIX signal that you look at, you're looking at your VAM, and your VAM's thing, as I understand it, volatility adjusted momentum signal. So you're basically saying, is price above a certain moving average to give me price momentum? And then is the vol, the realized vol, is that below the average of the realized vol? Is that for the momentum of the vol? How does that work?
Almost. You were correct on the price side. On the volatility side, so what we found, and obviously, I'm not the first person to read my man book. I've probably read that book 4 or 5 times now. But what you find is that when you transition to one side of a volatility distribution, you typically have higher price changes. And so what that model is designed to do is spot the median of volatility on that same medium term duration, to figure out, okay, if we cross over to here, we're probably going to have bigger price changes. And typically in financial markets, bigger price changes are associated with declines, with the exception of things like cryptocurrency, interest rates, spreads, those types of things have bigger price changes on the upside typically. But so that the model's smart enough to adjust for those kinds of variables. But what it's really designed to do is say, hey, if you're bullish, but we're on the wrong side of the volatility distribution, you need to be aware of that, because this is oftentimes heading into a downturn, decline in markets. That is the first warning shot. Volatility is the leading indicator for the price breakdown, and so that's why we anchor on volatility as
that volatility level, that volatility threshold. Is that just a fixed number, or is that moving?
No, it's a trailing number associated with whatever regime we're looking at, or whatever time price series we're looking at. For most equities, we're looking at something between 100 150 days. For most currencies, things that are lower vol, we're looking at something between 150 and 200 days.
Okay, interesting. And it's all realized vol you're looking at, not implied.
No. So it's whatever backtest best. Realized vol backtest best for most things equity. But things, obviously, if you have a liquid implied volatility index, then that typically works really well. For example, obviously like the VIX or the VXN for the NASDAQ, something like the VX XLV, or the silver volatility index, or the what's the FXI, the China volatility index. Those things aren't liquid enough, so they don't provide great signals. So we could potentially look at a stock implied volatility index like that. We could look at 10-day realized volatility, or not oftentimes, but there are times where we actually look at another market indicator as the volatility adjustment. For example, in most of our volatility adjusted momentum signals for commodities, the Bloomberg dollar index is a better backtest than those commodities' own volatility indices or their own volatilities.
And therefore you use that as opposed
to. I use the dollar. So when the dollar is breaking out, most commodities right now in our model, with the exception of most energy commodities, because they have their own implied volatility indices, most commodities, our models have been bullish, or not bullish, neutral for a while, because we've seen a bullish, VAMs break out in the dollar for the past couple of months. And so, that's a warning signal to us to say, hey, look, the coast is not clear with respect to levering up and taking the maximum amount of risk you take in this asset class, because you don't have this very favorable outcome that is dollar debasement, a weakening dollar. And we've seen it, in Q4, we've seen a lot of commodity price appreciation, but we've also seen some pretty massive drawdowns. You look at nat gas, uranium, copper, all these commodities have gone up a lot, but they've also had some major drawdowns as well. And that's because the volatility adjustment is telling you that should occur. You can still have a big move up from those lows, but that's
that's definitely something that's been making me nervous on commodity longs.
I'm certainly same here.
And then that VIX versus VVIX breakdown. So the way I read that or think about that is, if you're seeing that thing breaking down, you see that as a negative general risk off type dynamic, right?
Indeed.
And that's because the VIX is spiking more than its volatility, right?
Yes.
And the way I would kind of explain that is that people have got more conviction in just buying VIX futures, and they're happy to hedge their books in VIX futures rather than buying calls on the VIX, which is a vol play, and that would make the vol be more bid than the futures themselves. So a low conviction hedge might be calls on the VIX just in case. But if I'm really worried about the market, I'm just going to buy VIX futures.
That's right? You hit the. I couldn't explain that better myself. That's exactly how I think about it. There's the breakdown in the VVIX VIX ratio, or really the flip of that is the breakout in the VIX relative to its own volatility, is a rush for near term protection. I think the market is going down now. VIX calls aren't going to get it done for me. I need real downside protection, and that's typically what you see in big market events. You don't normally see that in just general market corrections, but you typically see that if the market's about to go down 10+%, you're almost always going to see that breakdown.
Yeah, that's interesting. Because often what you see when VIX is low, VVIX is quite high, because people are like, if I just buy a load of VIX, I'm probably going to lose money, but I'll lose less money if I buy out of the money calls on VIX, and I'll still own the crash if it happens, basically.
I think that's exactly it. It's the realization. You're going from generally hedging because you're in the business of being long risk to, oh shit, I need to hedge now because I want to stay in the business of being long risk.
Yeah.
Like that. It's that shift.
Interesting. Okay, good. Yeah. And And then the last thing about vol that I wanted to kind of talk about was, do you look at skew? Do you look moves in skew at all? So I often find that skew, particularly short dated skew, and if it moves a lot, is often a bit of a leading indicator to markets. I've seen that a lot in Bitcoin recently because I look at vol. Yeah. But is that something you keep an eye on, like what skew's doing and how, like in FX, it happens a lot, right? For example, when you've got a Brexit on the horizon or you've got some political turmoil happening in the country, the skew starts to shift and the tail risk starts to change. And that often gives you a bit of a lead indicator that asset might go through a period of weakness because of this political thing that's going on under the surface.
Yeah, no, I not as religiously as I look at the volatility risk premium, because that's in terms of what we're trying to do with that signal, which is really isolate, tactical near-term trading opportunities. Skew to me, I think, is more of a medium-term signal in terms of changing the direction of the medium-term price of the price momentum. And so, we think we have a decent enough model to do that already. But no, I do believe skew is a very important indicator. It would behind volatility risk premium, skew would be number 2 for me, a very close 1A, 1B type situation. I just don't have time to look at everything.
Okay, excellent, cool. And then just sort of wrap up, like, do you see this framework that you've developed at 42 Macro? Do you see it evolving? How do you think you could do it an even better job? And I think you're doing a great job already, but how do you think the model can be improved? Or what are there any things that you're working on to try and sort of mix it up a bit?
Yeah, and I mean, so like you just brought up a great discussion on skew. I'm already you're front running the front runner, but I'm already trying to build a model on skew that's predictive and well back tested before I obviously launch and introduce it to clients and customers. But yeah, so I mean, the reality is when you develop a quantitative process, or if you're a model builder really not just in finance but in any industry, you're never done. If software developers understand this better than anybody. Like, you could push out the best piece of code in the world and you're going to be working on it for the rest of your life. And that's part of the gig. And so to answer your question, yeah, we're always trying to find different parameters, different data sets that are more predictive than the ones we currently have access to, or the ones we currently know about. Obviously, yeah, no, the reality is we're always learning and training the models. That the answer that'll never change.
Okay. Yeah. Cool. Well, I'm excited to see what you come up with next.
Yeah.
And then lastly, I can't let you go without talking a little bit about the current market, right? So, you've been calling for a bounce in growth. You're saying that you think growth bottomed out in September, post Delta variant bounce. We're starting to see certainly prices reflect that a little bit on the little mini reflation trade. You look at some of the airlines, you look at the Russell 2000, high beta, shorted names, they're all squeezing. But if you look at the dollar and you look at long dated treasuries and you look at commodities outside of energy, they're maybe saying we're not quite in reflation. Maybe there's still a bit of stagflation, deflation under the hood that you need to be worried about. How would you explain that divergence across the different asset classes? Like equities is game on, clearly. What do you think?
Yeah, so I'll start by saying that on any given day, not every asset class has to agree with the grid regime. The whole purpose of the top-down market regime nowcasting process is to say, on a trending basis, this is how markets are generally behaving. If you have a 3-month window and it's been all reflation as the dominant market regime within that doesn't mean every single trading day in that 3-month window is traded like inflation. You could have had, a number of deflation days, a number of Goldilocks days. And what we're trying to do is identify the dominant market regime, because that gives us the highest probability chance of making sure that our risk management is oriented with what the market is giving us. I always say, I play football, and we have a saying in football, which is take what the defense is giving you. If they put, all 11 guys right in the middle, right in the box and standing next to the line of scrimmage, you probably don't want to run it right up the gut. You might want to throw it out to the flat. And so that's just kind of how I think about investing as well. It's, when you're in reflation, go do as the reflationists do. When you're in deflation, do as the deflationists do. And so kind of to answer getting back to your question, it's like the distribution of probable economic outcomes we knew was going to be flat heading into Q4. Like, just in terms of how our conditional probability math works on the nowcast and on the forecast, we knew that, hey, look, I expect the data to bounce in Q4, just based on coming out of Delta. We've seen this pattern several times now. So me as a human or, is training myself to react to that. But even if it does bounce, there's still enough of a chance, quantitatively speaking, that it doesn't bounce enough. Even just the impulse of coming out of Delta might not get you a sustained bounce in economic activity, because you're talking about base effects, you're talking about other dynamics like labor cost pressures, starting to eat into margins, things like that. And so we're picking up all that information in our outcast. And so, to answer your question on the dollar, on treasuries, I don't know that we were ever going to ever truly be fully out of the woods with respect to every asset market pricing in obvious reflation. And you've heard me make this joke several times, but I said, look, I said this back in late September, the reflation trade we're about to get in Q4 is not going to be like the reflation trade we got from November to June. That was the Jackson 5. We have the Hanson brothers over here. One made a lot of hits, one made a hit, and you're going to accept the hit from the Hanson brothers, no question, but it's just not going to be the same. You don't have the same dynamics. From November of 2020 through June of 2021, you had 5 things happening that almost never happened at the same time. I went back and looked at this back last year when I was doing the work on it. Since 1960, there's only been 10 quarters where growth was accelerating, inflation was accelerating, corporate profit growth was accelerating, the Fed was easing, and fiscal policy was easing at the same time. 10 quarters in 60 years, 60 plus years. And so we had like multiple of those quarters in the first half of this year coming out of November. And so that was obviously very historic inflation trade. Knock on wood, did an outstanding job calling that as well. And I think I did a decent enough job calling this one as well, but this one's just not like that one.
My sense is that it's almost like FX, the marginal participants in FX and bonds have got a longer term, I might be completely wrong here, but this is my sense, right? So they've got a longer term time horizon in their investing, right? So they're looking much further down the line. And as we've been saying, there's a lot of headwinds coming, right, in Q2 next year. So that you could argue dollar and bonds are reflecting that already, whereas you look at equities, who's the marginal participant in equities, right? It's like retail buyers, it's systematic CTAs, it's corporate buyback programs. They're the guys that are driving equity. And we have got the seasonal Santa rally that we kind of always get, right? Probability wise, it's quite high. So it feels like equities trades on a really short time horizon. The other assets trade on a longer time horizon. And that's the divergence we're seeing, maybe,
Well, you hit the nail on the head as well, in terms of talking about the different players. The breakdown in like 6 month and 1 year and 2 year realized volatility that we're observing right now is catalyzing more people to jump into the kiddie pool that is the equity market. You're going to see more CTAs increase their leverage. You're going to see more quant funds increase their exposure to U.S. equities as an asset class, because we're getting the appropriate volatility signals to suggest that. Once you lose the September and October corrections from last year out of the sample, all you're left with a massive decline in realized volatility on a trailing 1 year look back. And that's a big signal for a lot of big funds that I'm sure you're well aware of as well.
Yeah, exactly. I mean, because, Raoul always called bonds the market of truth or whatever, right? And I kind of think he's right. And, even you earlier this year were thinking the deflation comes in December timeframe, and you rolled that to Q2 next year. So it's kind of, we know it's coming. We know it's in our future. But you've just got to kind of navigate how we get there and when it comes, basically. And I think you do a good job of kind of changing your mind on that and like realizing that it's not coming yet. I'm not going to force it. If it doesn't want to come yet, I'm not going to force it. I'm going to take what the market gives me. And then I know that's probably in our future at some point. So I will do what I need to do to prep for that and kind of look out for that, basically.
Yeah, I mean, the alternative would be getting dressed in a home with no windows and just walking outside every day, like with no weather app on your phone, no windows, no internet. You just put clothes on and walked outside. Some days you're going to be lucky, and what I mean by this is the style of investor who doesn't use data and quantitative tools to help them adjust their Bayesian prior into a Bayesian posterior that is more appropriate for making money in financial markets. A lot of people never adjust their Bayesian prior. They just maintain the same Bayesian prior no matter how much data hits them in the head or in the chest every day. And to me, that's unacceptable. I think there's a better solution. I'm not saying I have the world figured out, but I do believe that we are
equities
leading in that regard.
Equities are notorious, though, for ignoring what's coming, right? I mean, I was doing this in 2007 and 2008, right? And the credit market blew up in 2007. Like the stress we saw in the credit market in 07 was a precursor to 08, right? And all of us were there who had our friends in credit saying the world is ending. We're like, well, not in equities, it's not, right? And equities was just up there for a good 6 to 9 months until it had its wake up call, right?
Yeah,
so,
I mean, I would argue that from the perspective of how I think about investing, which is dispersion, both within and across asset classes, equities did get the call in the summer of 2007. The market internally got very, very bearish in terms of the leadership within the market, with the exception of energy, because obviously we saw $150 crude oil in July of 08. But generally speaking, equities got the memo. It's just that the broader asset class didn't necessarily have that nasty decline until we obviously got into Q3 of 08. But it peaked in was it October 9th of 07? And the market was smart in that regard in terms of both peaking early and having the defensive dispersion that you would expect. It just didn't necessarily blow up to the extent that I think people who were closer to the credit situation wanted it to or needed it to at that moment in time. And quite frankly, thank God, if Keith didn't get fired for shorting stocks too early from Magnetar or from, what was he at, Carlisle, there was no Hedgeye in 08, right? And there's no Darius Dale talking to you today. So, everything happens for a reason.
Yeah. Fair enough. Well, it's been amazing. It's been really good talking to you. And I really appreciate you coming on. Hopefully the listeners found this informative. I'm sure they did. But it's been a pleasure.
Imran, I appreciate you, man. Thanks for all your guidance, your tutoring, man. I'm gonna feature you on one of our shows so you can teach me about options, man, because I'm still a novice in that regard. I use volatility as a leading indicator, but I do want to start to enhance my own returns in a way that I need to do a better job of that, because most of my money I spend on options goes into the graveyard. Yeah. as by the way, all of you know that.
That cracked me up. So true. That comment you made about short-term options being the graveyard of capital.
It's the graveyard of capital.
It's brilliant.
It's so true. And so I'm going to invite you on into our show, and I'm going to have you give us a masterclass on some of the pitfalls we need to avoid when we're putting on those trades. So thank you so much for having me.
Oh, sounds good. And there's no way I'm not bringing you back at some point, because I think we could talk for like 3 hours nonstop.
I know. We're going to have to do this on a summer Friday so we can both get some drinks. It'll be like noon my time.
Okay, cool.
Appreciate you, brother. Thank you.
Thanks for joining us today. I hope you enjoyed the episode. To learn more about Options Insight and our trading community, please visit us at www.options-insight.com, or you can subscribe to our YouTube channel and also follow us on Twitter at options_insight. Until next time, thanks.